Hi, everyone. Thank you so much for joining us. I can see quite a few of my VC friends here in attendance, a lot of entrepreneurs, um, some people from banks, and my special hello to the one person who's joining us from Royal Enfield today. I'm Ritesh, Stellaris Venture Partners, my colleague Mayank, also from Stellaris, and Jovina, who leads our marketing, is the MC for the event. We are joined by two panelists today, Lizzie Chapman. Lizzie is the founder and CEO of Zest Money and has been in the buy now, pay later industry in India for, believe it or not, 11 years. Prior to Zest Money, she started a company which was very creatively named Pay Later. Prior to that, she was with a UK based fintech company called Wonga. And before that, she was an investor in banks. So she brings a very long fintech and financial services experience, including the last decade or so in buy now and pay later. Our second panelist, Nitin, while we wait for him to join, I'll quickly share his background as well. Nitin is the founder and CEO of Uni. Uni is a new age credit card issuer and has been recently backed by a number of large investors. Nitin also has a very long and distinguished fintech background. Prior to Uni, here you go. Speak of the devil.
Hi everyone. Sorry I'm late. I was on the wrong link.
No worries, Nitin. We were only saying good things about you so far. Can't promise that going forward in this conversation, but we'll start off by saying all the good things about you. So just to repeat, Nitin is the founder and CEO of Uni. Prior to that, he was with Ola Financial Services, where amongst other things, he created their buy now, pay later and credit card products. Prior to that, he was the CEO of PayU India. So very long and distinguished fintech background here as well. I must already warn the audience that this group of panelists doesn't like to agree with one another. So we are hoping to see some fireworks here, and it is mine and Mayank's job to ensure that the fireworks do happen. So before we get started, maybe Mayank, if you can run through the hygiene items as far as the webinar is concerned.
Absolutely. Good to see that there are 50 plus attendees already. Just a few ground rules, please. There is a chat feature where you can basically discuss between yourselves. However, to ask a question to the panelists, please do use the Q&A feature that is there. And also this session will be recorded. So please do keep that in mind. Off to you, Ritesh.
Yeah, sorry, one more request of our attendees. We would really love it if you have a question. We would like to invite you to ask the question on video as opposed to just ask the question on text. So please do ask your question in the Q&A box, but then we will invite you up to ask on video so that we can keep it interactive. Great. With that, let's get started. So when we were actually even thinking of this topic, buy now and pay later, even in our team, we could not arrive at a consistent definition of what Bnpl is. And, our conclusion as VCs is that it means whatever VCs want it to mean at any given point in time. So it can be the 5 rupee payments that we make that we pay later, or it could be the 50,000 rupee loan that we take for a mobile phone. So my first question is to both panelists, and maybe we can start with Nitin. What is buy now, pay later? what are the various flavors of Bnpl, and how has it evolved in various countries so far?
Super. So Ritesh, while credit card is a very well-defined product by the regulator, it's a 30-day credit period, then there is an interest-free period of 15 to 25 days. There is no standard definition of Bnpl. It just means that you're buying something now and paying for it later. And therefore, the definition is all over the place. Let me start with examples in US, and then I'll come to examples in India. In US, we have all heard of the company called Affirm and Afterpay. Right? If you look at Afterpay, it's a 6-week payment product. You pay 25% upfront, and then you pay 25% after 2 weeks, 4 weeks, and 6 weeks. Right? That's how it adds up. It's a very clear payment product where affordability is not really the feature. Of course, you're paying payments over 6 weeks, but affordability is not the real solve that is needed at that point of time. What is needed is a convenient payment solution, right? On the other hand, if you look at Affirm, right, it is a 9 to 12 month affordability product. So you will, if you want to buy a Peloton bike of $1,000, you will never buy it on Affirm. Oh, sorry, on Afterpay. You'll always buy it on Affirm, right? Because Affirm is solving affordability where you're paying smaller installments over 9 to 12 months, whereas Afterpay is a payment solution. There is some affordability, but that's not a huge seller. Now let's come to India, right? There are so many flavors of the same product here in India. Bajaj Finance, the pioneer of Bnpl, is primarily an affordability solve. Zero cost EMI. You are going to buy a Samsung fridge at Proma, you will pay over 12 months, zero cost EMI, right? That's right squarely in the affordability bucket. Instead of me buying a 40,000 rupee fridge, now I'll buy a 80,000 rupee fridge because I can afford it in 12 months. On the other hand, if you look at Ola Money Postpaid, Simple, Lazy Pay, right? You are paying for your taxi rides, for your food on Swiggy, Zomato, on Big Basket, and you are paying after 15 days. There is no affordability if you're paying after 15 days. It is all about convenience because a credit line has no second factor authentication, because you can do one-click checkouts with Simple, Lazy Pay, Ola Money Postpaid. It is all about convenience. So two extremes. If you look at Uni, right, our product, which is called Pay 1/3 card, which is a Visa card, works everywhere, Visa is accepted. Automatically, all your transaction gets split into 3 parts, paid over 3 months, right? No extra cost. And if you can pay the entire amount end of month 1, you get 1% reward. What I'm offering to the customer is flexibility. You get 1% reward if you pay end of month 1, or give up that 1% reward and pay in 3 months, right? So proposition of Uni is completely different than either Zest Money or Bajaj Finance at one end and Simple, Lazy Pay at the other end. We're right in the middle, offering flexibility with meaningful lines. So this is how Bnpl just differs. Anybody can make up any definition and create a brand new innovative product, and that's the beauty of Bnpl.
Very interesting framework, Nitin, that it's a continuum between convenience products on the one end and affordability products on the other end. And you have, and I suppose what you're saying is that you have chosen to be in the middle of this spectrum to target your customer set. Lizzie, would love to hear from you both on where you have positioned Zest Money along this spectrum, and are there any other axes on which Bnpl can be divided into various categories?
Yeah, and I'm going to be really boring and completely agree with everything Nitin just said, which I know is not the idea of this panel. No, he did a brilliant description. That's exactly right. There's this brilliant sort of spectrum of pure convenience to affordability. The only clarification is, at Zest Money, we do sit along the spectrum. So maybe Nitin hasn't used us for a while, but our most popular product is Pay in 3, which is very, very similar to Uni. We have a different business model. We will talk about that. But from a customer product perspective, it's a very good insight that both of us will give you today. The fastest growing and most popular flavor of Bnpl, whether you measure transaction volume or GMV, is actually this Pay in 3. So I can verify that. I think Pay in 3 is a brilliant product because it combines convenience and affordability. It makes slightly too expensive products just look and feel cheaper. So we're seeing a huge boom in fashion, lifestyle, travel, D2C, right? All the kind of consumption use cases that are really growing in GMV right now in this country are loving using this product to drive consumption and drive revenue. The only qualifier I'll add to the definition, and I know we're going to go much, much deeper into this, but I will just say, when people talk about convenience versus affordability, you sometimes hear people say, oh, the convenience product is just a payments product. This is not credit, right? And I think that's lovely. That's a very customer-centric way of describing these products. But as the Bnpl issuer or anybody providing Bnpl, it's really important to understand that credit is involved, whatever duration, whatever ticket size. And that leads to specific challenges in operating this model, because you have to therefore create a profitable, or at least path to profitable business pretty early on whenever credit's involved, to be able to cover the costs of operating a credit model. So I get very nervous when I hear people talk about Bnpl in India and say, oh, it's just a payments product. It's just a payments product, because a lot of people all over the world and throughout history have lost a lot of money by not understanding that Bnpl is at heart a credit product. I think we're going to go a bit deeper though into the different business models, and that's where it gets interesting, and happy to sort of break down how we think about unit economics. And that, I think, is where you're going to see the biggest difference, at least in Uni and Zest Money. But I think from the customer perspective, we're all on the same page. We are about allowing people to have convenient affordability. Simple.
And Lizzie, you have seen this product evolve not only in India but internationally as well. Yeah. And would love to understand from you how and why Bnpl has come about in other countries, and what have been the drivers of growth of Bnpl in, let's say, a market like the US.
Yeah, that's a really good question. And for those that don't know, we started actually in 2011 in the UK building a product called Pay Later. We launched it in Poland, Spain, a couple of other markets, and then we tried to launch it in India. At that time, Klarna was actually going strong. They did have a pay in 3 product back then, but people forget that. And there are a few other providers. What was true then and is still true now, and I think is somewhat relevant to the India market, is this young generation of digital consumers in the West were becoming very skeptical about credit cards. Now, the entire credit card business model is predicated on a concept of late payment fee, effectively, or rolling outstanding balance. And that means when you do a transaction, and if you're young and you're sort of forgetful and you take risk in your life, there is a very high potential risk that you end up paying more than you thought if you put that transaction on your credit card. So as a result of that, a lot of consumers started to switch to buy now, pay later products because they had 10 times more transparency. They had a lot more kind of honesty in them. And then what you saw over the last 5 years, as Nitin explained, is the rise of these super value Affirm Afterpay. And they really played on that model. In Australia, particularly, now today, young consumers are, I think, a third less likely to have a credit card than they were 10 years ago. And they are 25% of them do all their online transactions on Bnpl. So it's almost become a credit card proxy or replacement for a younger digital consumer. The final thing, though, that's really driven the meteoric rise, particularly in the last few years, and this is a really key point when we delve a bit deeper into the business model, is you have seen a real adoption by online merchants to using these products. So 10 years ago, that actually wasn't the case. And 10 years ago, even in the West, Amazon dominated e-commerce, right? Today, we have such a diversity of online brands, and they all want to have a direct relationship with the consumer, but they sell expensive products. And so they're all using Bnpl as a conversion or marketing tool. So think about that from the investor's perspective. Why are investors giving crazy valuations to these Bnpl companies? And we're big fans of that, don't worry. They're doing it because suddenly you get a consumer credit product, effectively, or consumer credit plus payments product, but with a more SaaS-like upfront revenue profile. Most of these guys charge revenue upfront to the merchant, and that gives a much more stable and sort of sustainable revenue profile. So that's what investors love about Bnpl, and why you've seen specifically in the last 3 years, this like mega explosion in volume. And we predict that's going to happen any minute now in India.
Very interesting observations, Lizzie. So what you're saying in effect is not only does it provide convenience and affordability features to consumers, but also allows for monetization that otherwise would not happen because merchants are more willing to pay for BNPL than they are for other payment products.
Exactly. Exactly.
Nitin, would love to get your view on that as to whether merchants are, because you have been on actually on all three sides. You have you have been on the payment gateway side with PayU. You have been on the pure BNPL side, and now you're leveraging the existing card networks. So you're a representative of the card lobby as well. So would love to hear your thoughts on whether BNPL is less or more monetizable from the merchant side compared to other payment methods.
So, see, my view is that in India, BNPL is far less monetizable from merchant side. Let me explain why. See, in US, in many developed countries, you end up with almost 4% take rates on BNPL. Right? As a BNPL issuer, the merchant will give you almost 4%. In India, that number is 4% if you are offering affordability. So if you are Affirm, or if you are Zest Money, or if you are Bajaj Finance, then they'll offer 4%. But affordability is only for large ticket items, right? I'm buying a phone, I'm buying furniture, right? For a 1,000 rupee SKU, for a 400 rupee food, right? I don't need affordability. So 4% is available only on a small set of merchants where affordability is needed. And that limits the network, right? Today, Bajaj Finance is only 100,000 stores. Visa works on 6 million stores in India. So if you're looking for monetization from the merchant, you will only work on those merchants where the ticket size is huge, average ticket size, and affordability is an important solve. And that is not too many. There are only 100,000 odd merchants like that, at least in the organized sector. On the other hand, if you want to build a payment product, right? If you go to US, right? Afterpay is a payment product first, but they get paid 4%. Affirm gets paid far more. Now, why does Afterpay get paid 4% in US? Because in US, there is no second factor authentication. So frauds are high. So for any merchant, when they're accepting payments, it is not just the MDR that they are paying. They're also paying for frauds, chargebacks. They're also paying for, payment not getting realized, settlement not happening. Their fully loaded cost ends up at 3.5-4% anyway. So they are saying here I'm getting guaranteed, money from a BNPL issuer. While accepting credit card, my cost is anyway 3.5-4%. I'm paying a slight premium here. Oh, let me pay that premium, 20% premium, 30% premium at most. So it works in US very well. Now, as soon as you come to India, right? If you're Lazy Pay, Simple, Ola Money, Postpaid, I sold those, right? Your average MDR take rate is 1.5%. At 1.5%, you cannot give 8-month credit. You cannot give long-term credit, right? You cannot monetize the merchant meaningfully. And if you're going to make 1.5%, then why limit yourself to a few stores or few merchants? You would rather run on a Visa network. You will get paid this as interchange, and more easily you'll work on 6 million stores. So my view is that if you are monetizing the merchant, your base will be heavily limited. And this in turn will mean that your customer cannot use you everywhere. They can use you in limited places. Look at Bajaj Finance. They do 2 transactions a year. Their average spend on a Bajaj Finance EMI card is 30,000 rupees a year. On an average credit card, the spend is 120,000 rupees a year. On an average credit card, there are 48 transactions happening in a year. Here, there are 2 transactions, right? So there's a huge difference. Lesser engage the customer, lesser money you make. Lesser spends on the customer, lesser money you make. More engage the customer, more money you make. More spends on the customer, more money you make. And therefore, I am a big believer that in India, if you have to build BNPL, it needs to be built on back of Visa network, MasterCard network, RuPay network, and UPI network even. But the monetization will not happen meaningfully from a merchant. You can, of course, run it on these 100,000 stores as well. And BNPL networks very uniquely in India is available. The likes of Pine Labs and Innovati offer BNPL networks too. But they are very small networks. To expand acceptance, you need to work with networks, and therefore you cannot meaningfully monetize a merchant.
Nitin, if I were to rephrase what you just said in more provocative language, you have just thrown the smaller, more frequent cases of BNPL under the bus here. Lazy Pay, Simple, Postpay. These are what you called convenience products earlier. So not only are you saying that these are smaller ticket size products, even though they might be more frequent? You're also saying that they are not monetizable. And Lizzie earlier alluded to the fact that these are credit products, even though they look like payment products, which also means that that NPAs are high. Often, one of the networks that shall remain unnamed is running 20% NPAs as we speak. So, is there anything to love about the convenience product at all? Because
no, please. Why don't you finish? Then I will.
Yeah, I mean, these are low ticket size. These are not monetizable. They are high NPA. So, is there any way that product can be salvaged at all?
So at Ola Money Postpaid, we did make money, right? We made 1.5% MDR. We would make 1% from late fee. So our net fee was 2.5%. Now, if you can run that product at 0.4% loss rate of spends, you will make about 50 basis points as your cost will add up to about 2%. You will make 50 basis points as profit. That's 25% PBT margin or EBITDA margin, or at least contribution margin 3, right? Let me be real here. That is not bad. But what's the scale? How much will I process? Annually, $500 million, I can stretch it to $1 billion. On $1 billion, making 50 basis points is meaningless money, right? So you try to cross-sell more. I'll cross-sell personal loan. I'll cross-sell a credit card, right? So a convenience product of simple lazy pay Ola Money Postpaid, at least that's my opinion, right, is a great entry product to acquire customers and build some P&L. But you want to make a meaningful P&L, you need to get more spends or you need to cross-sell more.
Lizzie, would love to hear your thoughts on this, and particularly I'm keen to pick on something that Nitin said just now, that they made money they made 1% average as late fee. In your experience, how monetizable is the consumer in India, and is the consumer happy to pay that 1% late fee when they delay the payments at all?
Yeah, so actually, I agree with a lot of what Nitin said, especially on the small ticket product. But I love that you've picked the one place where we will diverge, and let's go there. So we have a different view at Zest. We really do, which is that we actually believe, and maybe I think we target a slightly different customer segment to Nitin, so it is relevant to the TAM. But we believe that customers in India are extremely fee sensitive, especially about late payment fees. They see them as a very low value for money expense, right? And you remember, we've been doing this for like 6 years. So when we've done experiments with late payment fee, we've discovered we've lost a lot of customers. So this is not a sort of hypothesis that's untested. On the other hand, we do find that merchants are surprisingly keen to pay us, and it's genuinely surprised us, because we came with the kind of numbers that Nitin's talked about. He's absolutely right. A 4% take rate in a Western market is incredible. I think the absolute best is about 5%, but even Klarna is at like 1.8 average, right? So he's absolutely right. We're at 8% average. Now, it is exactly what Nitin said. It's a mixture of, we do some of the longer duration, but we also make a lot of money on the pay in 3 and the 30-day. And I think it's because, and this is where I think we have slightly different business models, we spend a lot of time and effort almost acting like a marketing company for the merchant. So I'll give you an example. We we have very engaged customers. So we have an app. Our customers check into it like 1.8 times a day. There's a very engaged customer base. When we launch a new merchant on Zest Money, we will pop that up in the app. Customers will then go to that merchant, check it out, do a transaction. That means we end up being an affiliate to the merchant, right? So in some cases, we're the number 1 or 2 affiliate to our merchant partner. They will pay for that, right? You know how much digital marketing costs. They're paying Amazon 26%, right, for the same services, and we're a lot cheaper than that. So they see affiliate, they see us as a conversion booster if they offer it directly on their funnel. And they also see us as an AOV booster. And that's a really valuable thing. Again, think about these D2C brands popping up. A lot of people will come and buy like 1 lipstick, but what will make them buy 3 lipsticks? Oh, we do. So they actually see us as this really powerful tool in customer conversion, AOV management, bringing them new revenue. And for that, they will pay. And this is my point about India. actually, that's even more valuable in India because we have so many brands arriving here every day, internationally, domestically, whether it's Apple, Nike, or Sugar Cosmetics. They all need to grow user adoption and they need to grow GMV quickly, right? Maybe even quicker than they would in a Western market. And so actually, I think we shouldn't be scared to ask them to pay. We should be more demanding. I do think the merchant should pick up the bill. And that means we can give the lowest cost products to the end consumer. And that's something we feel very passionately about. We started Zest because we felt that credit was, insufficiently delivered to mass market consumers in this country. And we wanted to deliver the lowest cost, most, accessible form of credit. So the only way to do that at scale in our model is to make the merchant or brand pick up the bill. And maybe I'm just very good at persuading them, but so far it's worked and we're going to stick to that. So we make to answer your question, finally, we make less than 5% of our revenue from late payment fee. And we don't want it to ever go above that because we think that's actually anti-consumer in the long run. Yeah.
I just have one comment on the late fee, right? It's anti-consumer if you are not telling the customer plainly, honestly, and transparently. If you're sending 3 reminders to the customer and telling him that if you don't pay tomorrow, this is the exact amount of late fee you'll need to pay, then I don't think late fee is a problem. We in Ola ran many tests, right? We first introduced a late fee, which was charged daily. Then we increased the quantum of it. We saw retention rates. I think if you're communicating transparently and the user can say, I knew about it, right? There's no impact on retention rates. At least at Ola, we had 2 million monthly actives, right? So at least there it worked.
I'll keep these points in mind the next time I'm buying 3 lipsticks so that I don't get charged late fee. Great. Mayank, you had a question for Lizzie and Nitin.
Yeah, I think I think there is a fundamental disagreement. While Nitin believes that, merchant is not willing to pay, while Lizzie does believe that, merchant is willing to pay, and both have provided anecdotes, data evidence on either side. But I'm just wondering, is there a nuance of merchant segment here? And Nitin, to your question about fraud rates, I mean, if I look at Afterpay's data, while you're right, the gross, the MDR is in the neighborhood of 4%. But even if you look at the net transaction rate, net of all direct costs, including the fraud cost, Afterpay is actually pocketing 2% at a transaction level. However, I think the same number, for Indian companies is, if not 1/10, probably, if not 100, maybe 1/50th of that. So just wanted to understand, I mean, is there a merchant segment nuance? Is it that, the long tail in India is to a certain level? Would love to understand.
Mayank, just on the merchant segment point, you're right. It is very segmented. So I'm not going to claim that we have convinced any of the food apps to pay us 4%, right? I'd be smoking something. What I'm saying is where we add massive value to the merchant, that is where they will pay. So we look for segments or merchants or brands where they really, really need what we offer. And a bit of it comes down to, I think, where we're probably going to go down this path soon, but how good are we at underwriting? If we are good at underwriting and if we can safely approve customers that are new to credit or generally don't use other credit products, then the brand sees material value. So I won't name them, but we work with one very, very large OEM who really wants to grow their market share in this country. They sell smartphones, amongst other things. And they actually pay us a higher take rate than any other finance partner or credit card that they work with because we bring them new to brand customers. So it's really, really linked to the value you bring to the brand. That's how you negotiate your take rate. I'm not claiming that we can go out, widespread on every payment gateway and get double the MDR just because, we've got a nice logo. So you're right. There is a real diversity.
And just to clarify, when I meant fraud rates, I was talking about fraud rates that a US merchant faces when they're accepting credit cards. So the net cost of accepting credit cards is closer to 4%, is what the comment I was making. And what Lizzie just said, right? I completely agree with her. The nuance is not just merchants, but also in the kind of customer base you're underwriting. So if I'm underwriting a customer who already has a credit card, right? No Samsung or Apple or any phone manufacturer wants to subvent me, right? Okay, thoda bahut de diya, bahut badhiya. But if I'm doing a new to credit customer, then this equation meaningfully changes. See, why is Bajaj Finance able to command a greater premium from most OEMs? Because it is present in rural markets. No other lender is present in rural markets. And this gives them an advantage. So it's not just the merchant nuance. Of course, there's a merchant nuance, right? D2C will pay higher, they have higher margins, they want customers, all those things stay true. A merchant who has higher ticket size, right, is selling 20,000 rupee average ticket size, will be willing to pay more because subvention is because affordability is happening. But on the other hand, if you're bringing a customer base who is able to now purchase a product which he was not able to earlier, then also the brand will pay, the merchant will pay.
And so this is a great segue to my next question, which is, who is the customer for the Bnpl? And, how does one decide the segment for the Bnpl offering, and how does one underwrite that customer segment? And I believe that, again, I think on this question, both Lizzie and Nitin, you have taken a slightly different view in your respective businesses. So please do talk about the rationale behind that choice, and how do you really underwrite? Maybe Nitin, you can start off first.
Yeah. So just like there is no one single definition of Bnpl, there is no one single customer segment, right? You can go after any customer segment you like. So at Uni, we are going after super prime customer segment. A super prime customer segment is a customer segment which has been present on the credit bureau for at least a year. So they have a lot of data being reported onto the bureau, right? Whether they have taken a credit card or a home loan or a car loan or a personal or whatever, right? And for that customer, I have so much data coming from the bureau that I'm underwriting that customer basis the bureau data and telling them, why don't you take UniPay 1/3? 95% of all my customers have a prior credit card. I'm the third or the fourth card in their pocket, though I become primary immediately, right? So that's the customer segment I am underwriting, which I believe is very different from what Lizzie is doing.
Yes, it is. I mean, we do have some prime customers, and actually our prime customer segment has grown bizarrely over the last 18 months. I think banks did a pretty bad job of managing the moratorium and the pandemic, and we've won from that. But outside of that, our original hypothesis and why we exist was that we wanted to target ultimately the next 200 million households in this country. So if you look at the entire combined credit card user base, we've got some like 67 million cards in issuance. That's probably about 30 million unique users. Even if you add on the Bajaj and a bunch of the sort of more prime consumer durable lenders, it's maybe 50 million people or 50 million households. We believe there are another 200 million households beneath that who are not in any way, rural, poor, microfinance type households, but are middle income customers who are really just desiring simple things: a laptop for their kid, a new fridge, a great flat screen TV, maybe take a flight to visit their relatives versus a train. These are the type of use cases that we originally wanted to target. So we had to build our business model, i.e. our margin, and our risk models accordingly, because we can't depend on the bureau to underwrite the majority of our customers. It is meaningful for probably a third where we do get a good rich bureau score, but for 2/3 we actually have to use alternative data. We have to take a lot of risk, and we follow tried and tested models that are colloquially called low and grow. But what I mean by that is we will give a very small ticket exposure. We will learn on a customer over a couple of years until eventually we would almost be able to give him a credit card limit. So it's a very, very different target segment. It's hard, and it does, I'm afraid, mean you can't grow maybe as quickly, because we have to be very, very, very cognizant that we are growing our risk according to our exposure. Yeah.
Got it. Probably, at this time, would love to, take some audience questions. There have been a fair amount of questions from our audience.
I think quite a few very interesting questions have come up. So if we can figure out how to add a couple of audience members, just give me a second to figure this out. Jovina, can you add Shreya to the chat? She had a couple of questions. Great. Over to you, Shreya.
Shreya, you'll have to unmute yourself.
Oh yeah, hey guys. So I had actually a few questions. One of my questions is for Lizzie. So when you started off with the entire Bnpl, especially onboarding the first set of merchants, how did you go about it? Because you did not have a customer pool to show or any ROI calculations to show them. So how did you go about it? I'm just curious to know.
Thank
Second,
you. Nice question.
Second question is about, like you said, Bnpl is primarily lending and a credit risk sort of a space. So my question is, and since we do not have a lot of bureau data, and since there are a lot of new to credit customers, do you actually report regular payment behavior to the bureau and adverse behavior like missing payments to the bureau? Or is it just one way which creates like a double whammy for a customer? Like, how is it? Just curious.
I'm happy to take both, actually. They're quite easy questions. Thank you. The first one, I just love the question because no one ever asks that. And it was really hard. Onboarding merchants was really, really, really challenging in the early days. We had no data, no track record, and most alarmingly, no customers, right, to speak of. So the first few merchants we worked with took a massive gamble on us. Miraculously, it worked. And I think it's because we had the learnings from Europe. So we sounded credible and we just built a really good MVP. It worked really well on the first go. The first merchant we partnered with, which doesn't exist anymore, as is the typical case in startups, but is a good friend now. I just managed to convince by getting them drunk one night. I think it was very basic business development. And I convinced them. And within, I think, 2 months, we were 30% of their transactions. So they immediately saw the power. We gave a higher AOV, we gave happier customers. So I think we were just really lucky. Like if we had gone for Amazon on day one, we wouldn't have got that outcome, right? So we were just really careful about picking the right merchant and we got lucky and we did a good job. But it was slow, it was painful. It took, 2-3 years to get to any kind of scale on merchant acquirer, which is, I think to Nitin's point, why it is, nowadays it's much easier because you could use a UPI Rails or a Visa Master Rails. A lot of people use gift card as well, which is a bit like PPI as a Rails. By the way, we're not against that. We do that as well. So we're all about, we should be everywhere. We do direct merchant partnerships, but we also believe in using all the Rails available. On your credit bureau point, this is really important, and I'm glad you asked this. And I want to clarify more in my role as the Digital Lending Association, one of the founders. We believe very strongly that in India, we must count Bnpl as credit. We must report on Bnpl as credit from the perspective of the regulator and adhere to all the regulatory guidelines that apply to consumer credit. And that includes the Credit Information Act, which means we must report to the bureaus in exactly the same way as any other unsecured credit. In Europe, that is not happening. There is a lot of confusion, a lot of ambiguity. And regulators are now getting very alarmed because customers could have multiple Bnpl credit lines. None are getting reported, or maybe one is getting reported. And that's a risk of over leverage and systematic risk in the system. In India, it's still early. We don't need to make those mistakes. Let's get it right from the get-go. Let's get proper reporting. And I know a few of us, I'm sure Nitin as well, have been sort of working with the bureaus to say, can we even create our own reporting line for Bnpl specifically so that it's very clear when a customer has a Bnpl. At the moment, they're mostly clubbed under the same thing as a personal loan. And we think they're different products and they should be reported differently in the bureau. So this is something I feel very passionately about. And I want to champion that any Bnpl founders here or investors, please push for full bureau reporting. Very, very important.
Thank you, Lizzie. Kind of answers both my questions.
Great. Thank you so much, Shreya. We have a couple of other very interesting questions. One is from Prasid. Prasid, Jovina, can you try and add Prasid? Sorry, this takes a little while, but it's so much better to have it interactive.
Yeah.
Hello.
Prasid, go ahead with your question.
Yeah, thanks, Ritesh. Hi, Lizzie. So the question was, about the future of BNPL and how mass market players in India are to be positioned in the longer scheme of BNPL in India. And if the integrated shopping app model is the way that most of these players would be positioned going forward. Is that how you see it?
I love that question as well. We are going in the direction. So I think what Prasid is talking about is in the West, you've seen a kind of divergence where models like Klarna have moved into such high engagement products with the customer that they've almost become a shopping destination in themselves. So let's say I wanted to buy Ritesh 3 lipsticks. Today, I could open my Klarna app or my Zest Money app, search for lipsticks, and actually go directly to merchants where Zest Money is available. That is really engaging. Customers love it. They can also compare prices. They can look for deals and discounts. So it's almost like a deals app as well as a shopping app. So yeah, we're going in that direction. Some of the other BNPLs, so companies like Affirm, are going more in the direction of becoming full service financial companies. So they're offering like a checking account, debit account, and other financial products. We haven't started on that journey. We don't think that the market's ready yet. The BNPL opportunity itself right now is so massive. We think it really is day zero. It's going to grow 100x in the next 3 years. And so I'm guessing that, like Nitin, we're just so focused on the BNPL opportunity. But the shopping point that you brought up, Prasid, is a very natural adjacency. And if you think about our business model, which is all around, serving merchants, they love this because it's another site for them to be discoverable and aggregated, which is what a lot of D2C brands are kind of crying out for in this market.
Great. Thanks, Lizzie. I mean, if you don't mind, I'd like to ask a follow-up question as well. So do you see, players, corporates, and these large online platforms, do you see them getting into BNPL as well? Do you see them making a move in the opposite direction?
Yeah, no, it's happening. So Amazon, Flipkart both have their own pay later products, as you probably know. They're relatively successful. I'd say they haven't been massive yet. I think it's early days. And I think it comes back to this credit point. And this is my kind of general thesis on, will retailers or brands do their own BNPL in India? Unlikely. This is a very challenging credit market. And if they want to scale a credit program in the way they've scaled, say, an e-commerce program, they have to be ready to take a lot of credit risk, a lot of balance sheet exposure. And I'm not convinced that today their investors will reward them for that. The other thing I'd say is the single brand BNPLs or white label hasn't really worked that well in the rest of the world. Customers like brands, right? Customers like to identify with a brand. I think the Uni customer will want to shop everywhere. He won't want to switch to use a different brand BNPL on every shop, same as Zest Money. And so you can see that in the Bajaj behavior. If you walk into a Chroma shop, right? Chroma, by the way, is a Tata company. They have Tata Capital. It could very well be Tata providing all the loans in the shop, right? But it's Bajaj everywhere because customer has chosen Bajaj, merchant has chosen Bajaj. So my personal view is there will be independent pockets like an Amazon, Flipkart, Pay Later, but by and large, retailers will prefer to work with specialized BNPL providers. And it works better for the customer and most importantly, from the collections and risk experience.
Right. Yeah.
Great. Thank you so much, Prasid.
Thank you.
The next person I'd like to invite to ask his question is Saurabh. He had a very interesting question on merchant networks. Jovina, if you can add Saurabh.
Hi, Lizzie. Hi, Nitin. Sorry, the question I'd like to ask is, while I completely agree that BNPL is more a credit product than a deferred payment product, the lines do blur. However, how do you think about the friction related to abiding by KYC norms for credit products as the use cases become daily, more frequent ones, and much lower ticket size? Do you see customers going through the KYC process as things stand today, or I think the regulator and the government need to do a lot more to ease that friction?
Lizzie, this is right up your alley. You acquire customers in a transaction. I don't. I have enough time to do KYC.
I mean, we do a lot of off merchant acquisition as well. I'll be very candid about that. And we also try and work with the merchant to do what we call pre-approval. So we'll sign up customers before, for example, the checkout. But no, I mean, fundamentally, you are right, Saurabh. It is a challenge in India because most other markets around the world where Bnpl has grown quickly have either much more relaxed KYC norms or zero, right? So it is a challenge that we all face. On the other hand, I would say it goes back to this point about, are you adding value to the merchant and the customer? And if you are adding value, customers are actually, they're surprisingly willing to do things that we might consider painful and difficult, but if they see value in what they get from that. But I think to your point, and I think Nitin will agree, it is ticket size dependent. So I do fundamentally think it's very challenging to get in transaction KYC for a small ticket BNPL. I think that's going to be tough. I think you have to offer at least pay in 3 or more to get it done in the transaction. That's been our experience anyway. Yeah.
Thanks, Lizzie.
Saurabh, I'll ask the question that you had asked in the chat.
Please go for it. Yeah. While I joined as the panelist, the audio cut off, so I could hear which question you were referring to.
No worries, no worries. So Saurabh had another very interesting question, which was around riding on existing merchant networks versus building your own merchant network. Would love to hear both of your thoughts on that. Is it worth building your own merchant network, and in what conditions is it worth building it?
I've tried it twice. I built a wallet way back in 2015-16 called PayUmoney. Then I built Ola Money Postpaid, where I have to drive merchant network. I just find it too hard. Not worth the effort at all. So this time when I'm building it, I'm like, dude, I'm going to ride on other networks for sure. So my view is that the MDR that you get, the acceptance that you get, the amount of effort you spend, the limitation of cracking merchant one by one, right? It's just not worth the effort when you are not massive. If you're very massive, sure, everybody wants to accept Paytm wallet today. It's by default. But unless you're massive, you are much better off riding on other networks. Your acceptance is beautifully solved for. You are guaranteed an interchange. It's just beautiful. So I have a very biased view here.
I love that. I think Nitin was paying me a compliment saying that I've done something hard. So I'm very grateful. Thank you. No, it is. He's right. It's the hardest thing. It's a really long sales cycle. It's painful. It also requires a lot of maintenance, both technologically and relationship wise. It's just really hard work. So I'm not going to fight for only own merchant acquirer networks. We actually do a bit of both. We use PPI instruments. We're building a Visa open loop. So we're not kind of religious about this. I would just say though, once you have acquired the merchant, the depth that you can go is so powerful. And it's not just this point about getting paid more by the merchant, the take rate point that we've made a couple of times. It's also that the merchant works with us to acquire customers for us. We get, our merchant acquired customers are obviously free. But they also, do the heavy lifting. They help us even in things like recovery, collections, data. So it's when it works, when you get a really engaged merchant, it actually enhances the whole business model. So that's why we are profitable on the portfolio. We make money. And I think that's because of the depth of our merchant relationships. It has a CAC benefit. It has an OPEX benefit. It has a credit cost benefit. And so we wouldn't give it up. But I do agree, Nitin, it's meant that we've probably grown a bit slower than we should have. And I have a very hard job, and I get woken up in the middle of the night many times because someone's complaining that they want merchant support. So I totally agree with that.
Great. The next question is from Aishwarya. Chavina, can you please add Aishwarya? Okay, if we are having trouble with that, maybe I can ask the question that she had put up on chat. Her question was more around the regulation that the new, there she is. Go ahead, Aishwarya.
Yeah, so this was more in the context of the recent digital lending paper Lizzie, and I love the fact that you brought about something on responsible credit, right, and systemic risks, right? And if we recently saw the paper, right, RBI is very particular about the NBFC or the lending body having sight of the customer. How do you both think this will pan out in terms of the pay later models? Because currently whatever is there is largely unregulated, and it gives a certain flexibility as well. And secondly, what would you want to see? I mean, being an ex-banker, I can't resist asking that.
Lizzie?
Yeah, maybe I'll tell. We're actually in the very boring, we like to be regulated camp. So we do have an NBFC. We've got every license that we can possibly get, actually, because we do think that licenses are important and valuable in a market like India. No, but to your point, we are very nervous about the non-regulated BNPL. It's not going to scale. RBI has been very clear from the get-go. I also think it's astounding that someone thinks they can build a payments product in this country with no KYC. I mean, even a wallet has to have basic KYC. So why would this not need KYC? So no, to me, it's not ambiguous. It's very black and white. And as the Digital Lending Association, we have communicated to RBI that we would love clarification so that we don't see too much proliferation of unregulated BNPL. And look, I think we're far away from systematic risk. The ticket sizes are still very small. It's still a relatively small pool of customers using these products. But why not start now with a good framework? By the way, it's also good for the companies, because the thing investors like least is surprises in regulation. So we think let's start now with a really clean framework we can all buy into. At DLAI, we've been leading a lot of discussion on that, and we'd welcome anyone, to join DLAI to fight the good fight. But we want interactive, progressive, but very, very transparent regulation to make sure the industry grows in a safe and sustainable way. That's very clear.
Yeah, I just echo those thoughts. I think I don't know why fintechs are hesitant to get an NBFC license. They should just get one. Right? Not too much capital requirement. RBI is just asking you to be fit and proper, right? Basic requirements. So there has been this mental barrier. I'll not become an NBFC. I think with this draft guideline, I think every fintech will just embrace becoming an NBFC. On the unregulated stuff, right? I think there are only very few specific players who ran 15-day convenience products, who did not do KYC and ran BNPL in an unregulated fashion. Every other BNPL player has been doing proper KYC and either lending from their own NBFC books or partner NBFC books in a clean way. So because of some very specific, now one player left who is doing unregulated BNPL, I think the industry gets painted unregulated. That's not true.
That's the banker's excuse for not launching, right?
Really? Naughty banks. But I totally agree.
I thought this was a banker-free zone.
That's why I said I can't not bring it up. Thanks a lot. Thanks. It really helps to know your thoughts.
Yes.
Thank you, Aishwarya. Our next question, and probably the last one for the session, is from Himanshu. Himanshu, please go ahead.
Hey, hi. I think I had one question around like the overall user behavior in India as far as payments is concerned. It's kind of like now dominated by like Paytm, PhonePe, Google Pay, and obviously like in some sense UPI. So isn't that the like natural place for BNPL to go in the longer term, right? Because users are already using these apps for payments, and now it's just like I would say one tap away to shift to BNPL. So whether it's like a closed loop QR based payment, like a Paytm postpaid, or let's say even like a UPI QR place, which is let's say a bullet. So what do you guys think about it? Like, is that like the overall like longer term evolution, or you think that the market actually will remain in different segments?
Lizzie, you want to go first?
No, go on. That's your specialized subject.
Yeah, I think UPI on credit is just bursting to happen. And I think the regulator is just holding it back. See, there is no clear regulation of how UPI will work on PPI. That's the problem. So there are two ways, right? You either make it work, you make the PPI, you make the credit line disbursal into a bank account and UPI works on that bank account.
Sure.
Or you make the credit disbursal into PPI and UPI works on PPI. From an RBI point of view, both are fine. However, today UPI only works on a bank account. UPI on PPI has to be given a green signal by the regulator NPCI. That is where things are. The day it gets green signal, I think you will have 100 probably 1,000 players doing.
No, but I mean, like UPI, because the MDR is 0, right? So there is no money to be made from merchant.
Yes, and this is where my argument comes in. You make money from the customer.
Paytm postpaid can make, right? Paytm postpaid can make money from the merchant side.
Not even that. See, even for Paytm postpaid, right? The deals that they have with merchants is 0 MDR on UPI. I don't think you can monetize a UPI transaction from the merchant's end. You just can't. So you have to monetize this from the customer's end.
But postpaid is not a UPI payment. No? It's a closed loop.
No, irrespective of that, I'm saying the MDR, whenever the customer merchant is receiving payments, right? The MDR is not meaningful or is close to 0. That's how things have been set up. And in India, there are very few P2M UPI QR codes. Most of them are P2P. And there the MDR is anyway 0. So I don't think you can monetize a UPI transaction, even on if it's running on credit from the merchant's end, meaningfully ever. You have to monetize it from the customer's end. And standalone UPI on credit will never be a successful business model because you'll not have enough spends and therefore you cannot monetize the customer meaningfully. It will always be a subset of a larger line or a larger product. Lizzie is doing 5 things. This is a 6th edition. I'm doing 5 things. This is a 6th edition. Something like that.
Yep. Is there any different views on UPI on credit?
So boring. We agree again. I know that wasn't the plan. No, you're absolutely right. I think Nitin's completely right. I think there's some murmurs have come out this week, right? That there may be some thoughts around MDR, blah, blah, blah. But I don't think it will get meaningful enough. And I think more importantly, to Nitin's point, merchants are not going to accept. They're just not going to pay for it. So we would have to continue to make our merchant take rate on direct integrations. And exactly as you said, that would just be an add-on on product. But I am positive it's going to come. I really do think it's coming. I think you're right. There's going to be 1,000 companies. So get ready for the deluge, but probably the next 1 year, I think it will be there finally. So fingers crossed.
Fantastic. In the interest of time, I will ask one more question that Suman has posted, which is the applicability of Bnpl for B2B transactions. And they actually asked in 2 different contexts. One is for SaaS kind of use cases, but the other was SMB credit use cases. Do either of you see an applicability of this to more business transactions?
I mean, SME credit is pretty obvious, right? I'm a supplier to a retailer. Retailer owes me payment. The retailer pays me later, right? So the retailer uses a BNPL. So in B2B context, BNPL fits right in, right? There are payments happening and you are delaying that payment using BNPL. So any supplier, so any creditor, right, where there is a regular supply of goods and a payment has to be made and a payment has to be made in 7 days or 30 days, right? BNPL is a great way of extending the time frame. So for SMEs, it's a no-brainer, right? And many forms of this BNPL have started to exist in specific supply chains in India already. So it's not a new thing, right? I think the product has started to take off in the last 2 years, even in B2B supply chains from a SME perspective. From a SaaS perspective, I don't have a view.
Great. If we can maybe spend another a few minutes. I know we are over the time, but there's some very interesting questions coming. This one I'm sure both of you will enjoy. This is from Utkarsh on whether traditional banks can do BNPL as well as the startups can. So maybe, Utkarsh has a very interesting point that they already have the distribution because of their card and banking products on both sides. So how much do you see existing banks as a threat in the BNPL space?
So this is a repeat, right? In 2015, when wallets started to take off, every bank launched a wallet. 16, 17, 18, how many wallets came in, right? You don't see any bank wallet surviving. It's the same thing. Banks will come, they'll try their best, and they'll be lost. I think Lizzie answered this question really well a little while ago, that it's a very specialized job. You have to crack a merchant network very, very hard. No bank can crack a merchant network, right? You have to solve for very, very different myriad of problems, right? It takes entrepreneurial founder energy to solve for it. I don't think a bank will be able to play there, but I think Lizzie will have a better view.
No, I actually agree again. I think there's one that's doing a good job, which is ICICI. They've got a really innovative way of thinking about it. The others have tried and struggled. And I'll add a data point, which is that they've approached us, many of these banks, and said, can we work together on this product? So maybe my sort of counter view is they know what they don't know, and you will see some of the smartest banks partner with BNPLs and share their customer base, but use our underwriting, infrastructure, merchant network, et cetera, et cetera. So watch this space. It's too early, but banks have woken up to it. They definitely want to play a part in it, but the smart ones know that they can't replicate everything that we've all built, and that they don't have that kind of customer touch and feel. Customers want a very different feel when they use a BNPL to a bank. That's why we exist, because they want a much more transparent, fresh kind of feel, right? So I think you're going to see partnerships and collaboration. That would be my crystal ball.
Yeah, I completely agree with that. Banks have the lowest cost of balance sheet, right? So just powering balance sheets in a co-lending model, and co-lending is really good, right? The 80-20 framework that RBI has defined. 20% comes from the BNPL's balance sheet, 80% comes from the bank's balance sheet. I think that's a very beautiful business model to scale. Bank wins, they get a balance sheet, they get the customer, they make ROA. The BNPL player wins, they get the customer, they make an extra margin. I think that's a model which can scale.
So you mean Axis Bank is not going to make another acquisition for $300 million?
That was for $40 million, by the way. It was not 300.
Great. So I think we'll wrap up the questions. Would love to do a very quick wrap on what you see as the future innovations if you take a 3 to 5 year view for each of you. What would be, what's the future of this space? A couple of things from each of you. Maybe Lizzie, you first.
Just massive scale. I really think it's day one. I mean, if you look at the entire BNPL market of even the non-traditional guys, just the online guys, it's a couple of $1 billion. We think, Klarna is $50 billion. So we think that there's going to be $100 billion GMV in just, one of our companies in the next couple of years. So it's so early in the journey. That's my biggest prediction. Expect massive, massive, massive growth and adoption. I think the big question will be, what direction do BNPLs go in? If they can't become profitable on the core product, which some can't, but we hope to, then it's going to be a challenge. You have to come up with another, if lending is the answer to all fintech business models and BNPL companies can't make profit, then that's going to be the big question. What direction do they go in? But my sort of abiding final thought is, don't be scared to make money in this product. It is a valuable product to the ecosystem, to the merchant, to the brand, to the customer. Charge for it. It adds value. And let's make this one of the few profitable fintech models in this country. That's my ambition.
Amen, Lizzie.
No, I echo
your thoughts on what are the 1 or 2 key innovations in the future?
See, I think banking for too long has been a liability first relationship, a bank account first relationship. I think that will start changing to a credit first relationship. And given the flexibility that BNPL product has in itself, right? It's a very, very flexible product, can be used in myriad of ways. I think the first relationship that a financial institution at scale will have maybe a credit or a BNPL first relationship. And basis that, an entire financial services company might get created by building that relationship first. So when you see a new bank, right, $50 billion company, credit first relationship, you see a Tinkoff in Russia, credit first relationship. I think an opportunity like that can happen in India. We'll start from a credit first relationship. Somebody will scale to 50, 100 million users. No bank, by the way, has these kind of active credit relationships today in the country today. 50, 100 million users just having a credit first relationship with that institution, and then build financial services around them. That's the opportunity that exists in India and for a particular player.
Fantastic. So in a few years, we are looking forward to Uni Bank being that bank.
Oh yeah, every fintech aspires to be a bank. I can tell you that.
Absolutely. Great. Thank you so much, Lizzie and Nitin. It has been a pleasure, and it was both a very insightful and a fun discussion. Thank you so much.
Thank you for having us over.
To our audience, please do feel free to write to all of us or any of us on Twitter and LinkedIn. I don't think any of us use Facebook anymore, so don't bother. But feel free to reach out to us and continue the discussion on social media. Thank you so much.
Thank you
so much. Thank you.
Thank you.